Thank you, Brian, and welcome back, everybody. I'm in the market actually for an AI version of me. I think it would make my diary a little bit easier if I could replicate. But welcome back to this session. We're going to be talking about the future of fixed income markets, and I've got a fantastic panel here to talk to me about all of that. But first of all, what I want to do is just set the scene a little bit, because the future of fixed income markets is one thing, but just figuring out what's going on in the current state of fixed income markets is another thing entirely. So, you know, it's been a lively year so far for fixed income. We've seen some really big moves in core rates markets. There's a lot going on. There's politics, there's inflation, there's geopolitics, there's supply. There's a lot of competing forces going on there, and yet the main thing that really sticks out to me is just how resilient bond markets have been. It is quite incredible. So what I want to do just to start with is introduce Jessica Pulay from the DMO to talk about, you know, Jessica, you're at the sharp end of this, right? You're at the issuance end of the market. Tell me what this year has looked like for you so far, and whether you share that impression of resilience.
So first of all, thank you very much indeed. It is a huge pleasure to be here at the QE2 Conference Centre on the occasion of, I think it is the 58th annual ICMA conference, and really to have the opportunity to welcome so many important market participants from around the world here to London, and to thank you for bringing the sunshine as well. I am particularly pleased to be joining this panel alongside such a distinguished roster of speakers from across the financial sector. So thank you very much indeed for your kind invitation this morning. And also, Katie, thank you for your question. So you mentioned some of the dynamics in bond markets generally. And this obviously includes the UK government bond market, the gilt market. And it's clear that geopolitics, the macroeconomic environment, the second-order consequences of all of these things, and they have, to a certain extent, catalyzed a global repricing, and the gilt market is no exception to this. But that happened a few weeks ago. Conditions have moderated somewhat since then, and I'm sure we'll be spending time on this panel discussing some of the combination of macroeconomic and geopolitical factors which are influencing bond markets at the moment. But what I would like to underscore from the specific perspective of the UK Debt Management Office, we have responsibility, operational responsibility for delivering the UK government's financing programme, is that the gilt market has adapted to these conditions in a very orderly way. And indeed, the gilt market has a long track record of responding both to changes in market pricing as well as to episodic periods of volatility smoothly and efficiently. And let me put some numbers on this. So at the end of March 2026, really just 8 weeks ago, less than, the UK government delivered the 2025-26 financing remit. This was in a size of 303.9 billion. It was the second highest remit ever to have been delivered for the UK government, and the highest ever in terms of net gilt supply sold to the market. And this was delivered smoothly and effectively. Our own operations, and I mean our auctions, as well as our syndicated offerings, continue to perform extremely well. Indeed, only a month ago, in April, we raised the largest amount ever for the UK government. This was a 15 billion pound transaction at the 10-year maturity. It went extremely well. We saw a wide diversity of different investors participate in that transaction. And we were able to do this, I would argue, because over the past couple of years, we have made a few tactical adaptations at the DMO to the way that we deliver the program within the overall framework, which has served us well for decades, of being transparent, predictable, and regular as a borrower in the capital markets. All of you who are investors in this room will know that there are many uncertainties to navigate in the market. We don't want the UK DMO's debt management schedule to be one of those uncertainties, but within that, the important adaptation that we made this year was at the margins to introduce some flexibility into that program, to engage with the market more actively, and thereby to ensure the successful delivery of the program, because we were providing those bonds which the market was wanting. So that is the first aspect. The second tactical adaptation that we made this year, and again, a very important one, was to reduce the weighted average maturity of our issuance profile. This reflected changes in the structural nature of demand from particularly the UK pension fund base, but it has been going on for some time, and we responded to that. And I believe that has also been well received by the market, and we're in a position to respond to that because we still have in the UK the longest weighted average maturity by a significant margin, even taking account of this adaptation, compared to our G7 peers, and that remains the case even after these adaptations. We've added a few more because we announced our financing remit for this current year, which, by the way, is slightly lower than last year, so it's 246.2 billion on the gilt remit compared to over 300 billion last year. But we also announced a couple of additional adaptations. The first is that we are now able to deploy switch auctions this year, which the market has very much welcomed. We also launched a consultation with our colleagues at the Treasury at the beginning of this year. We published only on the 5th of May, just a couple of weeks ago, some of the responses and what we plan to do, which is to introduce a new T-bill maturity and various other adaptations. So overall, that combination has served us well. Our cover ratios are very robust. Our syndications are, as I say, extremely well received.
Yeah, that's really good to hear. It's funny, I was at an event the other day, and one of the topics that came up was this shift in demand and the way that the long end demand isn't there in the same way from the pensions community, the pensions buyer base. And they were saying, what are we going to do to rekindle this demand at the long end? And I said, well, we've got to move on, right? We've just got to adapt to market conditions as they are and move to where, meet the buy side where it is. But thanks for that, Jessica. And I told you we had a good panel here. So John Winter, Vice Chair at Lloyds. Again, I find this resilience really striking. Do you?
Yeah, thank you, Katie. And again, thank you for the opportunity to be here. If we just look at some of the volumes that are happening in the market at the moment, some of the resilience you referenced becomes apparent. So for example, in dollars this year, we'll see north of $2 trillion of investment-grade corporate bond issuance, and potentially on top of that, another $300 billion from the hyperscalers. We've seen them hit the dollar market, the euro markets, the sterling markets, the French markets. So we could clearly have a record amount of issuance in dollars. In euros, we're on track to be a record year as well, north of €1 trillion of issuance, and in sterling, over 150 billion. So the volumes are consistent with what Jessica's saying about the broad demand. Interestingly enough as well, when you look at the investor base for that, it is cross-border as well. So for example, in euros, in our estimate, roughly 30% of the buyers of euros are here in the UK, mainly in London. So there's broad-based demand and a continued sort of upswell of appetite for risk, despite the volatility geopolitically and otherwise.
Yeah, it's a really important part of the picture. So in a change to your advertised schedule, we do not have Michael Roberts from HSBC Bank here, but we do have, very sportingly, Adam Bothamley, who's the head of DCM for HSBC, has stepped into the breach. Thank you for doing that, Adam. Talk to us about what primary markets have been like so far this year. It's been lively.
Yeah, it has. And thank you for having me, even if I'm a last-minute substitution. It has been really lively, and I think you mentioned at the start, with everything that's going on in the world, using words like orderly and resilient. I would go further and say, we're in a record-breaking market. That's true in terms of the volumes that we're seeing, which have been already spoken about, in terms of the outcome on transactions. As Jessica mentioned on the UK syndications, we're seeing that in certain other markets as well. And so the market is not just being resilient, it's actually hitting new highs in terms of demand and what's achievable in global capital markets. And maybe it's worth just thinking about why that's the case. For me, the biggest driver of that, and we started off talking about yield levels, we have seen a big repricing in global rates markets. That has continued to drive capital inflows into fixed income products on a relative value allocation basis. And whilst yields remain at these sorts of levels, one would expect that to continue to be the case, particularly as we see buoyant equity markets. And as equity markets remain hitting new all-time highs, we keep seeing this reallocation of balanced portfolios back into fixed income to make sure that they're maintaining that portfolio weight. So that structural demand is likely to continue. I think the second thing is around the global flows that we're seeing. So we have this huge emergence in wealth in areas like Asia and in areas like the Middle East, which is complementing the traditional demand that we continue to see in developed markets in the US and in Europe. And as that Asian wealth base grows, as Asian investors look to continue to diversify their holdings, and as we see relaxed regulations in places like China, as evidenced by the opening up of the southbound Bond Connect channels as an example, we would expect at HSBC to continue to see that flow coming into global fixed income securities. And then finally, I think if we look at credit specifically as opposed to sovereign markets, in certain markets around the world, we have seen this material increase in credit quality in the investment grade markets, both on an outright basis and relative to certain sovereigns. If you look just at leverage across the sovereign sector globally relative to the corporate sector leverage, it's right that we've seen a repricing tighter of credit in places like the US. And I think investors recognize that, and that's why we're able to, continue to see this exceptionally strong demand, even if we are at close to record tight levels in terms of corporate credit spreads.
Yeah, absolutely. But it is this funny environment, isn't it, where everything's gone wrong for fixed income and everything has gone right for it at the same time. Jonathan Peberdy, CEO at Natwest Markets, tell us what's your perspective on that? Again, you've got this insight into how primary markets have been functioning.
Yeah, no, I mean, I think again worth reflecting. As much as many of us would like to forget, but just how difficult March was. I mean, we've seen this complete and total reversal in terms of market expectations for inflation, for interest rates, from pricing rate cuts to pricing rate hikes. We'd already had this theme of, concern around fiscal, levels of debt and obviously defense spending needing to increase. And so, steeper curves. And so we came into that March window with this extraordinary sort of cocktail of different concerns, and it led to a very, very material repricing. And I think the speed and scale of it, there's a lot of, a lot to reflect on there, but clearly there were a lot of very well held positions which came under pressure, and I think that led to a lot of the, the severity of it. That said, where we are now, we see rates certainly in the UK would see rates much closer to fair value. And I think, we had a conference last week and heard from a lot of investors that they're really looking at actually engaging with the gilt market, some of them for the first time. They see rates as being very good value here. You've heard from John and Adam, and Jessica already, when people are looking at the markets and, they're trying to assess, where is a good opportunity. If you think, despite the fact that we are near record tights in terms of credit spreads, actually your sort of total return, given outright yields, is actually, well above average, well above average. And so, there is a really attractive proposition here, and that's why we're seeing these inflows. And I think when you reflect on the scale of supply from the hyperscalers and, how will the market absorb it, will there be crowding out? There's no sign at all at the moment. And I think, obviously that's something to keep watching very, very closely. Sovereign supply remains elevated, lower in the UK for this remit, but it remains elevated. But, having this huge weight of supply, I think 23 billion between Amazon and Alphabet alone in a short window, the deals that followed those all heavily oversubscribed as well. So I think that real resilience around the value proposition, around inflows, that's where we are right now. So it was a sort of a fairly torrid repricing, but we'd see that as being very rational, and now is a good point, and we see an attractive opportunity there.
So the buy side is there, and it's changing. But Julia Hoggett from London Stock Exchange, well, I told you I had a good panel. One thing that some countries around the world are doing is looking at these huge piles of retail deposits and saying, how do we convert that into retail demand for longer-term fixed income instruments? Even Luxembourg is looking at war bonds. It might already have done them. I can't remember off the top of my head. But how do we explain to retail what bonds are and get them more involved in this?
That's a very good question. I think, look, if you look at what the UK has been trying to do over the course of the last few years, it starts with how do we make sure retail have access, actually have the ability to buy fixed income. One of the things that have happened over the previous 15 years is we've actually made it harder and harder for retail to buy what I would describe as regulated product, whether that's primary and secondary issuance in equities or in fixed income. I stopped being a fixed income issuer in 2009, but we have had a continuous decline even past that point in retail participation. If they can't buy it, it's hard for them to understand it. And I think as a public good, the reversal of the rules in the UK so that issuers can issue down to £1 denominations off their wholesale prospectus, and we've now created access bonds at the exchange to lean into the FCA's regulatory changes, actually also helps financial literacy. When we had the mini bond scandals, people were being told that 6.95% with a 5% already taken out of the structure was the risk-free rate.
But you might get a burrito with it, so...
Possibly. But the simple reality was, it was good in part. They didn't really know what the risk-free rate that ESCA was issuing was, because they couldn't get regular access. And it looked too good to be true, but nobody had the comparison. So I think one of the things that we've cared about is how do we make sure that retail can access it? And then talk through the fact that fixed income, as it is for institutional portfolios, is an entirely rational part of retail participation. And I think it is about a broader evolution of the retail savvy in the UK, which brings us to Savvy Squill, which is obviously the long-term campaign that 20 different institutions have come together to create, to actually, in effect, almost culturally reverse the effect of 15 to 20 years of telling everybody to be scared of investing, and actually to make it accessible, enable people to understand the product. And as someone who's been in the fixed income market my entire career, it's only ever been a rational part of someone's portfolio, and yet we have structurally made it harder and harder. So having that reversal of what is quite boring pipes and plumbing, which is what I spend most of my time looking at, is critical to the underpinning of facilitating it. So I agree with you that unlocking those pools of liquidity from retail into this market is also important, but I'd say it's important for retail in their own right to have access to these products and to have access to plain vanilla fixed income products that are charged the same credit spread as the institutions are paying. I think that matters.
Just to build on what Julia is saying, I think the LSE deserves credit for the exercise earlier this year to be the first mover to take advantage of the FCA's new policy around plain vanilla listed bonds, the PVLBs. And I think the redenomination exercise you guys went through, where you took the notional from 100K minimum to 1,000, and retail can now buy it in smaller denominations, own it on Crest, rather than Euroclear or other areas where they haven't been able to own in the past, is an indication where you're backing up what you're saying, and really trying to create an example of how we can have securities out there which are eligible for retail to purchase.
Yeah, and maybe just to add again, it's a tremendously important innovation and hugely supportive of that. And the liability management exercise was a great step. And I think the next part will be working with issuers to encourage them to engage and issue in this new plain vanilla listed bond format. And I think retail having such a heavy weighting towards deposits, it's a similar theme when we think about the progress that we've now finally seen some of in the Savings and Investment Union.
Yep.
You know, if you think in Europe, you've got 10 to 11 trillion euros of deposits, and you think about the financing needs of the continent and the companies, and you know, financing innovation and data centers. We can maybe reflect on, you know, sort of European capital markets versus US. But for me, that real harnessing of that retail support is just tremendously important. And you know, from a UK perspective, it's it's a really fantastic innovation. And I think to your point, you know, these are by definition, these are very liquid, vanilla, understandable products with attractive yields, per my relative value comments earlier, and should absolutely have a home in a retail portfolio. And I think you look around Europe, you know, and some countries have done this better than others. You know, in Italy, you can access bonds as a retail investor much more easily in a bank branch. You know, food for thought.
That's an idea.
No promises, but you know, but for me, it's just such a natural step, and it's such a big pool of liquidity that you know, both sovereigns and you know, corporations need access to.
Yeah, but that somehow something gets lost in translation between, you know, people in this room who understand this stuff and get the benefits of it, and the general public. And I'm not quite sure how we bridge that gap. But I do know that when I get a little email from my ISA provider every now and then saying, oh, there's a new gilt on the market, would you like to buy this gilt? I then get 8 paragraphs of reasons why I should not buy this gilt, right? You know, it could be risky. It's a gilt. You know, it might go down in value. Sure. You know, but you know, here's a bunch of reasons why you should not buy this gilt. And there's a tiny button at the bottom that's so small that I can't get my finger to click it that says buy the gilt. And I think, what are we doing here, guys? This is not a risky investment, but I don't know how we reset that. I mean, Adam, what's your take on this? Do you think that thinking differently about the buyer base could be an important input into how you do DCM?
Yes, I think so. And look, I agree with everything that's been said in terms of harnessing retail. You know, it's a fairly specific UK phenomenon, in the sense that we have in various markets in Europe, as John mentioned. You know, Germany's a good example where you do have a pretty buoyant retail market for fixed income securities. If you think about areas where we have large private banking networks, whether it be Switzerland, whether it be Hong Kong, Singapore, you know, fixed income investments are a large part of those portfolios, and actually, you know, more at the riskier end of the spectrum rather than the vanilla bonds. So look, I think that, you know, we certainly would share the views that have been already given around developing the UK retail market. You know, to me, is it a problem of communication? You know, probably more so than anything else. I think that we have probably as an industry, you know, got ourselves into a point where the issuances themselves are more complex than they need to be. You know, in the spirit of trying to add features that are helpful to borrowers, we've probably, you know, got to a point where even if, you know, we all understand and believe that those features are not adding risk to the instrument, they still take explaining. We probably need to go back to basics a little bit in terms of the securities and structures that we're offering. But there's no question that unleashing that kind of retail bid for fixed income in the UK has got a huge amount of upside for borrowers and for liquidity in the market. And I think particularly in the context of a European market which is, you know, progressing, you know, well, but is still, you know, relatively fragmented. You know, I think the UK does have a great opportunity to establish, you know, probably the strongest, the most liquid, the deepest market for retail fixed income investment. You know, given some of the autonomy that they have, and some of the dynamics in terms of demographics and wealth in the country. So, yeah, look, I think it's a huge opportunity. I think communication and simplification are you know, key kind of things we need to do to achieve that.
Yeah, big part of it. Julia?
Well, I'm just going to frame a bit the way we thought about the retail component piece in CMIT, the Capital Markets Industry Task Force. We sort of thought about it through 5 lenses. The first was you actually needed to enable retail to be able to buy the product. You know, that was a simple reality. If the only thing they could buy was something with 100k denom, they weren't going to buy it. So first thing. Second thing was those, what I might describe as dirty great risk warnings. You know, you could lose all your
Those
money.
8 paragraphs.
The 8 paragraphs.
You could make it 2, perhaps.
So the IA and the FCA have got together to change those risk warnings because they were aware that they had actually caused problems. The next was access to advice, because some products, and particularly when you move towards the equity side, are advised. Now, through the RDR, we had lost an awful lot of IFAs on the high street. What the FCA has done with the Advice Guidance Boundary Review and simplified advice is deliberately to try and address that. The next was we were one of the only countries in the world that gave people a tax break to keep all their money in cash, which was the other component piece. So actually thinking about actively investing through the incentives that the government creates and the ISA reform as well. And it was only then that you could do the change in mindset and the cultural piece, because you actually needed to put all the other groundwork in place. If you had a big campaign that said, go out and buy fixed income, but by the way, you need 100K, by the way, you're still going to face a risk warning like you have, and by the way, the ISA regime is basically going to incentivize you to keep your money in cash, and you can't speak to anybody about it anyway, it wouldn't have worked. So the timing was very deliberate in terms of the order of these things. The key point is, this is deliberate. This is the regulator, the government, the entire ecosystem saying we want this to happen. The next thing is actually behavioural change on the part of the industry to stop doing what I would describe as teeth sucking, which is, you don't want to do that, you know. It is actually to turn up to your compliance teams and say, look, the IA's risk warning language has changed. What are we doing about it? The issuers want to sell to retail. What are we doing about it? And we all need to own that objective decision that we need to change. But let's also remember, this isn't rocket science. You know, I used to run one of the largest covered bond issuers in Europe. Used to sell to retail all the time, all over Europe, as a standard thing. That has happened forever. The London Stock Exchange started because we were trading gilts to retail. You know, none of this is actually innovation. This is just getting back to our knitting and remembering our core purpose.
And sorry, I just want to really quickly bring in Jessica here, because you've obviously been very responsive to the different makeup of the buyer base in fixed income. What are your views on what you've just heard here?
So first of all, I share the views of the panelists, and over the past 4 years, there have been strong indications of a significant pickup in interest from retail investors, albeit from a low base. There are many reasons for that. I should just note that there is, alongside DMO, a specific entity within the UK government which is responsible for retail investment, national savings and investment. But for gilts specifically, we have certainly seen anecdotally that those volumes are picking up for many reasons, not least the macro environment changes that we've witnessed over the past 4 years. It's quite challenging accurately to gauge the level of retail ownership. It largely appears to be concentrated in the short, low coupon, low cash price bonds, which trade below par, and therefore are particularly efficient for retail investors. And indeed, we issued one of those just this morning through one of our new programmatic gilt tender offerings. The Bank of England have recently published a paper which shows the growth of some of those holdings. Most of the retail participation is at the moment in the secondary market through the retail aggregator platforms. But together with one of our retail primary dealers, gilt-edged market makers, or GEMs, there is now a facility whereby retail investors can participate in primary gilt offerings with one of our wholesale GEMs on the same terms as other investors. And that was an important initiative, the inception of which was about a couple of years ago now, and has proven successful.
Yeah, no, that's really interesting. Thank you. John, sorry.
Just quickly coming back to your point about your finger hovering over the,
the tiny button.
The tiny button purchase. What we have found is an encouraging amount to get people going on this is to participate in some of the DMO's treasury bill auctions. I think the retail participation in some of the 3, 6, 9-month maturities has been encouraging. And the arithmetic is simple. You're getting 2 or 3 times what you're getting in your current account. It doesn't feel that risky, and therefore it's a way to kind of get going.
Yeah, no, it's a good point. So look, getting the buyer base right is important, and getting the basics right, getting the general public engaged with fixed income markets is a really important part of the picture. But, in terms of the future of fixed income markets, what does that look like to each of you? You know, I know there've been efforts to do a few bonds that are executed on the blockchain, and why isn't that sort of mainstream now? Is there a good reason why it's not mainstream? Why, you know, what sort of an innovation do you think we might see in the way that bonds are born into the world and then traded in the secondary market after that?
So that I've been in the markets here in Europe for you know, since the early 90s, and it's very tempting to say what I see in the future is kind of an extension of what we're doing today.
Yeah.
Because we've been talking about, you know, structural reforms, more corporate lending, moving from banks into the markets and things, but it hasn't really happened. But to sit on a panel and say that's too boring. So I'll throw out a couple of things that I think could be different. When you look at, if we just look at spreads, for example, there's a view that we're all talking about. Spreads seem super tight. However, if you look at a couple of anomalies on that, in the US, for example, you have corporates like Microsoft and Apple rated AAA, and the US government rated AA1, AA+. And so as fiscal pressures mount, could we see more corporates or non-government entities be viewed as better credits than the sovereign? And so could we have continued spread tightening, and in some cases even negative spreads, where there is just some risks perceived as you know, superior? Possibly an isolated case. It feels as unlikely to say that now as it did probably 15 years ago plus to talk about negative interest rates, but I think it is possible. And then on the technology front, I think that there's a real chance that digital assets become viewed operationally as so much more superior than what we have today. You know, settlement failures and so forth basically eliminated, that they really do take off, not because there's incremental distribution, but just because it's so much less complex and less risky operationally to trade between counterparties, whether it's collateral management, other ways to do this. And the result of that could be a de-risking of big chunks of the market, and therefore, for those of us holding capital against our operational risk, RWAs against that risk, we could end up in a situation where the regulator allows us to hold less risk because so much has been de-risked from the system from digital, by embracing digital assets more fully.
Yeah, it's an interesting point. I mean, Jonathan, where do you fall in on that? You know, are Apple bonds the new treasuries, and what other sort of innovations do you think we might see?
Well, I think for me, just to pick up on the technology piece first, I think, you know, certainly I think that, you know, that has to be the future. And I think, you know, clearly been talking about, you know, distributed ledger and lots of, you know, private ledgers, and we've seen a, you know, vast increase in the number of digital bonds being issued. ECB had trials, obviously. You know, the government's looking at digit, you know, at the moment. And I think, you know, the future has to be, you know, clearly it works. Clearly it massively de-risks the whole process. It makes it, you know, far more efficient. It reduces the cost. It, you know, democratizes, you know, the asset class. Like, you know, it's incredibly exciting. But I think, you know, the big challenge is, well, how do we scale it efficiently? How do we connect, you know, digital assets into, you know, already existing infrastructure? And then really, how do we scale, and how do we get to that next step? And I think that's where we are. That's where we are now. I think, you know, the reality is we're going to have this parallel system for a period of time, and I think the risk is that, you know, unless we get the interoperability right, you end up fracturing liquidity rather than improving it. So I think, you know, we all need to, and I think, you know, the last speaker from BlackRock, if I'm right, you know, talk to the same thing. Like, we've got to be really, really focused on how we, you know, use this moment to really improve liquidity. But the end state, you know, for me is an exciting one. And I think, you know, when you add that to the, you know, the conversation we just had about retail and the way that, you know, the next generation of retail investors will, you know, consider their investments and look at assets, you know, you could see this converging in the future. And I think, you know, what's vital along the way is, you know, transparency. You know, the consolidated tape coming in, it's a really positive and meaningful step forward. So, you know, transparent, more liquid, more available, more accessible, you know, fixed income markets that can trade 24 hours a day. I mean, you know, that we can't be that far away from that. But I feel very optimistic that we'll get there. But it's just navigating this journey is the key.
It is incredible that we're still sitting here talking about the consolidated tape, but here we are.
But here it is.
Adam, John mentioned a really interesting point there, which is about how do we get corporate UK and corporate Europe more plugged into fixed income markets and less reliant on bank financing. Part of the reason why they don't do that is it's just like a pain. There's a lot of paperwork, especially if you're a relatively small issuer. Does technology enable us to smooth out some of those wrinkles, do you think?
No.
Cool.
No, look, I think there are two issues. I think if you look at the European landscape, if you look at the global landscape, clearly if you think about, bond financing, capital markets financing relative to bank financing, the US is way ahead, Europe's somewhere in the middle, and Asia is well behind. Why is that fundamentally the case? Partly it's to do with the kind of liquidity and ease of access and lack of fragmentation in the US capital markets relative to other markets around the world. Partly it's due to the conversation we've been having around buyer bases and making sure that there is, a reliable pool of capital for, not just big investment grade corporates, because when we have this discussion, really you're talking about the new to market borrowers and sub-investment grade names, et cetera, where that market is less well established in Europe than it is, for example, in the US. And without wanting to stray into the topic of sort of capital markets union and European fragmentation, that's a topic that needs to be addressed to really open up those capital markets for borrowers across the rating spectrum. And if you look at the other side of that is the attractiveness of bank financing. The reality is in Europe, we still have a bank market where you have a lot of medium to large sized domestic institutions in each individual country that are going to offer financing terms to corporates at rates that are very, very attractive relative to for example, capital markets. So I think that is the big driver of why we see this kind of lower percentage of capital markets financing in Europe. From a technology perspective, clearly that is something that and I agree with everything that's been said. Digitization, tokenization of markets is the future. Indeed, at HSBC, where we've conducted specific research on this, and we recently had a future of finance poll, we talked to over 3,500 decision makers, and interestingly, close to 90% of those respondents said that they expect digital capital markets, digital assets to be a core part of their strategy going forward, but less than 50% said they actually understand the use case today and have the tools to implement that. So we see as a financial institution, a big client need there and something that we're very much trying to be at the forefront of. We're delighted and honoured that we're working with the UK to be the platform provider on the Digit. We have a well-established tokenised bond platform in Hong Kong, where we benefit from linkage into CMU, which has interoperability with Euroclear and Clearstream, which is something that we don't currently have in Europe. So I guess my point is that to develop that market, financial institutions and the public sector need to be working hand in hand to develop that, because corporates and individual institutions on their own don't have the capital, the tools, and the time, frankly, to sort of work on that kind of market development piece.
Yeah, Jessica.
Yes, I probably should come in, given Adam has mentioned the Digit, and just to explain to those of you in the audience who may not be so familiar with what this is. So the DMO and Treasury particularly are keen to innovate the approach to the markets, and therefore Digit is a project which was actually launched by the Chancellor of the Exchequer in November 2024. It's an important innovation. It has obviously the potential to assist in the future transition of fixed income markets, and it aims to explore, it's a pilot, and I should just note this, it is a pilot transaction which aims to ensure or explore how government can use digital technology across the life cycle of the sovereign debt issuance process, and therefore has the objective of catalysing further UK-based, particularly DLT infrastructure and the adoption within the UK financial markets. So the Treasury and the DMO have been working jointly on this project. Adam referenced the platform provider announcement, which was made in February of this year. and we are engaging with other parties as providers at the moment as well. I should also just note that this digit will be issued within the Digital Securities Sandbox. This has been established by the Bank of England and the FCA, and this will be outside the DMO's normal debt issuance program, if you like. We're obviously working with our colleagues at the Treasury on this, but it's outside the program, for example, that I outlined earlier.
We're kind of out of time, but as the dame on the panel, you get to have the final word, Julia.
Promise me you weren't going to do that. No, the thing I want to say is that, look, in terms of this innovation towards digital, I run a division in LSEG called Digital Securities Markets, and I have done for some time. So I think that illustrates that we view this as fundamental to the evolution of our markets. We actually already do on-chain capital raising for private funds, and we've built that as the first exchange to do so. We've announced that we're building a DSD to very much facilitate that transition between what one might describe as analog assets and digital assets. The simple reality is these two worlds are going to live alongside one another. What Samara Cohen said was entirely right. I was nodding all the way through her speech. What we need to do is make sure that we hold dear the core requirements of markets, the things that I always say regularly are the last two things that should go in this transition are sovereign control of monetary policy and sovereign control of securities regs. But there is an increasing amount of value sitting in digitally native form. And actually what we don't want is two separate pools. We want the ability to be able to translate between the two. And I'll be provocative. I would like more of that value to be going into productive assets, whether that is equities or fixed income, things that actually drive economic growth and reflect underlying economic activity. And so for us as an exchange, we are building all of those component pieces so that the innovation that is being done through Digit becomes actually the playbook for how you operate regulated markets with those core principles using the best of what this technology can offer, but recognizing that we will have an analog world, as you call it, for some time to come. And the trick is to make sure that the two can operate and interoperate between one another.
I mean, provocative maybe, but it sounds like good common sense to me. We really are out of time, so we're going to have to leave it there. But please join me in thanking the panelists today. Thank you.